Peter, I have been grossly remiss in not focusing on your world. How threatened are those municipal bonds we own that are assured AAA, AA, and A? How under threat are they?
Yeah, that's actually a really good question, because I think a lot of people are misinterpreting this as being bad for the entire market. So it's important to separate out the market. Now, the segment you pointed to, we'll call it A-rated, AA, and AAA. I think there's a lot of guesswork going into what the pandemic and the economic shutdown mean for the U.S. and mean for municipal bonds. The high yield part of the market, the project finance, let's leave that alone. That's going to be under a lot of pressure, and we see that in retirement centers and stadium bonds, et cetera. But the bread and butter of the market, which are the general obligation bonds, even revenue bonds, you look at MTA, which has certainly been under pressure. They came to market 2 weeks ago, and the deal was oversubscribed, and it shows the essential nature of the service. It shows the long-term viability that the market believes in it. So there's a lot of noise still to come, a lot of uncertainty around all of this, including in the municipal market. But the idea that states and cities are going to declare bankruptcy around this, or your bonds are not going to pay, is just not correct.
Peter Hayes, what has the price of bonds done? I remember talking to you years ago when California was blowing up. Price down, yield up. What a huge opportunity to create total return in California paper. What have municipal bonds actually done as they await Washington's salvation?
It's been a roller coaster, and I guess that's probably true of most asset classes when you go back to the beginning of March. We had a 2-week period where the index went from, the Bloomberg index went from up over 3% to down over 11%. And that occurred in probably 7 or 8 trading sessions. It peaked on March 23rd. Then there was a big snapback because of that total return relative value that you talk about. Investors recognized the opportunity that was being created, so they snapped back a little bit. But they haven't come all the way back. Now, yields are still low, but when you look at what we've done compared to investment-grade corporates and treasuries, et cetera, we haven't rallied back as much. In fact, the index now on the year is actually back to about flat. So remember, beginning of the year it was up 3.7, come all the way down, now we're back to flat. And I think it's because it gets back to your first question, Tom, around the uncertainty and the impact of what will happen in the market going forward. I think, the Fed did come in with the municipal liquidity facility, which is a good backstop for issuers that having the source and bridge cash flow needs. But they haven't done anything directly in the market, and now perhaps over the last 7 or 8 trading sessions, the market feels much more healthy. Maybe they don't have to. And the state of Illinois came to market last week, oversubscribed many times. They were able to upsize the deal. They came at a premium spread, so they're certainly paying for some of the economic pain and some of their credit situations actually coming into the market. But nonetheless, the market cleared. So I think that the market is beginning to heal itself, but it still has a long way to go.
Peter, do you think that the Fed will actually go into negative rates? And what would be the impact on, therefore, muni bonds?
So I've never been interesting question. I've never been a real believer in negative rates, and certainly if you believe Chairman Powell and the Fed rhetoric lately, you wouldn't think so. It seems that the economy would really have to take a big second wave downturn that would prolong this recession well into 2021, I think, for rates to go negative. Might they get close on the front end? Well, they're pretty close now. But I think first curve you get, it's difficult to see negative rates. It's difficult to see what's happened in some of the European countries and elsewhere around the world happen in the U.S. So I'm not a believer, but rates may fall again. I still think there's sort of a lot of economic uncertainty. I don't think the market has fully appreciated the magnitude of this downturn. Look at retail sales last week. Look at the jobs numbers. So we could go lower in rates. And when we go lower in rates, likely that municipal yields will go lower as well.